We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is the little green chicken. You guys know him as Doomberg. They're an anonymous publisher on Substack. They write some very interesting, thought-provoking pieces, and they cover a really wide range of topics. Doomberg, thanks for joining me today.
Tom, it's my pleasure. It's really a great honor to be on your show. Big fan of your work.
Thank you very much. And, big fan of your guys' work too. You put out, like I said, some really interesting stuff. And, yesterday when I was digging into the massive amount of articles that you guys have already written in your 8-month history here already, seems to be a theme that kind of keeps coming up again and again. And it's something that, in today's day and age, with all of the supply chain shortages, the energy shortages, there seems to be this theme kind of present in a lot of your work. And that's the unintended consequences of some of these short-sighted policy changes that we're making. So do you see that as well as a theme coming up over many different areas that you guys write about?
Yes, absolutely. It is a theme. And that the ability to write those pieces flows from the experience of the people at our firm. We have, I think, pretty uniquely in the sort of content creator space targeting the investor class and Wall Street, we come at these issues from a basis of substantial industrial experience. As senior leaders in large firms that participate in what investors would call the commodity sector, we have a pretty unique understanding of how the just-in-time supply chain is hyper interconnected and where certain critical nodes matter the most. And then when we see disruptions in those nodes, it's pretty easy for us to quickly connect those dots and then be able to write about them ahead of the news in many cases. And that's been, I think, a key reason why the Substack has grown as fast as it has, which we're totally grateful for and humbled by. But the reason why people like to read the Doomberg pieces is because we bring that industrial perspective. And one of the things we take pride in writing our pieces is our ability to explain things, especially complex things like technology and interconnected supply chains, in a way that is very accessible to the non-scientist, but in a way also that informs them and may feed their own investment process as they think about how the events unfolding in real time will ultimately play out 3, 4, 5, 6 weeks down the road. And so that's been a real boon for us. It's one of the, we find it rather unfortunate, the manner in which these critical decisions are being made. And all we can do is sort of highlight it for our readers and try to point out the fallacy of some of these decisions in the hopes that somebody with some power eventually reads it and listens or hears about it. But that's our contribution to the sort of intellectual zeitgeist, and it flows from our pretty substantial industrial experience that we bring to bear.
Mm-hmm. Well, when we think about that as well, it seems that there's sometimes a no-win solution to some of these problems. I was reading another piece this morning about Line 5 and the fact that it feeds a critical amount of oil to the States from Canada, flows through a critical juncture in the Great Lakes. You were saying at the end of the piece that Biden is really in a no-win situation there, right?
Yeah. And the piece that you referred to is one of our favorites, called An Urgent Call on Line 5, where we discuss the predicament that the Biden administration finds itself in because this critical pipeline, which does bring oil from Alberta across the plains and ultimately underwater over the Straits of Mackinac, which is the real controversy here. It's been doing so for many, many decades and quite safely, but the environmental movement has moved on from Keystone and is beginning to target critical choke points of infrastructure, and Line 5 is one of those. And they have a very solid argument that makes it controversial. If it were to have a serious accident, it would cause substantial ecological damage. The Great Lakes is home to 20% of the world's fresh water supply. And the company that runs Line 5 had a pretty serious pipeline spill in the state of Michigan earlier, in years prior. And so it does. And the governor of Michigan ran on a platform that included overtly shutting down Line 5, and she won election handedly. And so she's attempting to follow through on her campaign promise. And it should be noted that in that piece, we didn't take a strong position either way. We were just highlighting the menu of terrible choices that our political leaders find themselves in because of the pressures of the environmental movement when they run up against the laws of physics. And the real issue with Line 5, of course, is that it's a key source of propane, indirectly. Propane gets manufactured from the inputs of Line 5, and the Upper Peninsula of the state of Michigan is the number one area in the country, the US, for the use of propane for home heating. And what are these people to do, right? And so we sort of pride ourselves on being human first and physics first. And the real consequences of some of our decisions ultimately manifest in the form of some humans winning and some humans losing. And these are trade-offs that people don't like to discuss or don't even like to admit exist. But eventually, the price of physics has to be paid. And one of our tweets that went viral, we said, in the war between platitudes and physics, physics is undefeated. These homes need to be heated somehow, or people are going to die. Mm-hmm. And so the battle over Line 5 is a real interesting one because we suspect that Biden comes from Delaware. Delaware is the home of DuPont. Biden knows industry better than most would have you believe, and is sensitive to the politics of running up against physics. And we suspect when we wrote that piece that Biden was not anxious to shut down Line 5 and deal with the political fallout, 24-hour loop on Fox News of people freezing in the UP.
Mm-hmm. Yeah, and it's an equation, like we said before, that you can't really win. A lot of the homes that are heated by propane can't be reached by natural gas lines, or not necessarily can't be reached, but the infrastructure is not there to be able to heat them. So
that's correct.
This kind of parallels with a little bit of what we're seeing in Europe right now. Like, natural gas prices have never been higher. They're spiking unbelievably. And what do you think that the main cause of this is due to? Do you think that a big part of the move to try and push for the green grid to support most of Europe is just not there yet? And then the gas ends up being too expensive when you have to go back and rely on it?
Yeah, so it's a combination of factors. Crises, while a spark might have lit in the fire, crises are often a combination of a spark plus some kindling plus an accelerant. You don't just build a fire with a match. And this is a fire that has been brewing for several years. So there's a series of issues, and we've written about them all sort of separately and then sometimes in one large overarching piece. Mm-hmm. One issue is, as you alluded to, some of our politicians actually don't have a unique understanding of the difference between intermittent power and baseload power. And in Europe, there's several factors occurring all at once. One is they have been systematically shutting down nuclear power, especially in Germany. They just took another 3 nuclear power plants offline on December 31st of 2021. Mm-hmm. That is a critical amount of power, but more importantly, it's a critical amount of baseload power. And it is widely known that if you overload an electric grid with intermittent power like renewables and wind, that the grid becomes destabilized. So that's one. Two, there's an ongoing attack on fossil fuels. Like it or not, that's just the way it is in Europe and in some parts of the world, including the coasts in the US, for example. Well, that led to, drilling for new natural gas, domestic supply to be, and when I say domestic, I'm talking about the broader EU, UK, even post-Brexit, I still sort of count them as part of Europe. Mm-hmm. They're not supporting the, North Sea as much as they were. And the court decisions against, local major oil companies in Europe saying that they need to divest. It's not an environment that makes one feel great about investing in exploration and development. Most urgently, I think that explains a lot of the issue was in the spring of 2021, natural gas prices already started to get elevated. And the European leaders didn't fill as much natural gas as they should have. And then as summer became fall and people were warning about this, we certainly weren't the first to highlight it. It became apparent that there wasn't going to be enough. And I think they probably didn't never overestimate the intelligence of our political leaders. They probably don't know that there's a limited supply of liquefied natural gas capacity in the world, and that isn't going to be just some Band-Aid they can put over a small wound. And the US, thankfully for Europe has been expanding its LNG capacity, but we wrote a whole long piece just explaining the mechanics of why natural gas is not a global commodity. It's not a global commodity. Mm-hmm. The price of natural gas today in Europe, as you alluded to, is $30 per million BTU. And I'm looking up at my Bloomberg right now as we're talking, and it's $3.80 in the US. Well, that kind of arbitrage exists because it's not a global commodity. And there's a finite amount of natural gas that can be loaded onto ships and moved between what are otherwise trapped markets. And so the US, through the revolution in shale, has become the world's largest producer of natural gas, so much so that it was effectively free here for a while. I mean, if you took the oil to gas ratio, even today, the oil to gas ratio in the US is over 20. And on an energy content basis, it should be 6. So that tells you that, because oil is a liquid, it has a substantial premium attached to it. And because natural gas is a gas, it's harder to move around. And so what enveloped then was a huge spike in LNG natural gas. Prices are set at the margin. And at its peak, natural gas spiked up over $60 per million BTU, which, to put it in numbers your audience might be more familiar with, is the equivalent of over $350 oil on an energy basis. And that is, there's no other way to say it. It is a colossal failure of leadership in Europe that is going to have devastating consequences to their economy. And those consequences will be felt by the people least prepared to deal with it, i.e., the bottom third of their economic ladder. That happened. The consequences of it will reverberate for years. And we're just beginning to see how the interconnected supply chains, the snap of that whip, it's going to hit. It is beginning to hit. And we could talk about the 1,000 different ways it's going to hit in the next few months for sure.
Yeah, I'd like to kind of move to that. There's another piece that you wrote where you were talking that we could see $300 a barrel oil. So what are some of, let's say, the downstream effects of energy being that expensive in an economy that is experiencing price rises in every aspect of daily life?
It's funny you referenced that piece. It was one of our earlier pieces, and some people, we have a lot of comments and emails, and we interact with our subscribers as much as we can. And some people thought that that was a little clickbaity and maybe unrealistic. And we point out the fact that natural gas, which isn't oil, but is just as important in our energy suite, has in fact gone above $300 a barrel equivalent in Europe and in Asia today. And we wrote a follow-up piece to that just a few weeks ago called "There's Not Enough Oil." Ultimately, because of switching and other issues, and because of we come from heavy industry, we understand that it takes many, many years and lots of capital to develop new supply. And if you're going to frustrate the flows of capital to that industry, it's going to manifest itself in substantial increases in cost, because as we've said many times, the price elasticity of demand for energy is actually just the price elasticity of demand for life, because energy is life. Mm-hmm. And very quickly, you are forced with the question of who can afford to pay it and who can't. And so specifically to oil and oil to 300, that piece just looked at oil as priced in ounces of gold. Mm-hmm. And because I believe gold is money, I'm sure that's a position that you would be supportive of. Mm-hmm. If you go back to the previous all-time high price of oil, 145, let's say, dollars per barrel. And all these are US dollars, which I'm sure your audience is used to being quoted in. If you actually, recast the historical price of oil as how many ounces of gold did it take to buy that barrel of oil, and you take the price of gold back then for that $145 barrel of oil, and you just, replay it forward to today's price of gold, then just simply returning to the all-time high price of oil in ounces of gold produces $300 a barrel. Mm-hmm. Not out of whack. And then one of the things we highlighted in the piece called "There's Not Enough Oil" is what we're seeing today in the shale patch is in fact a harvesting of previously drilled wells at a rate that is unprecedented. And so we opened that piece talking about gold rush in the Yukon and how there's always this balance between the need to strip a cut versus sluice the cut. And if you're underfunded, you're often shutting down your sluice plant because you haven't spent the money to open up enough cuts. Whereas if you're very well funded, you can always keep a healthy supply of open cuts ahead of your sluice plant, and then you could optimize around running your sluice plant 24/7. And so in the shale patch, a very similar phenomenon occurs, which is sort of drilled but uncompleted wells. And so it turns out that drilling the well and then completing the well are two separate processes run by two different teams, and there's an inventory of such wells that are tracked. And we came upon the ability to sort of articulate that by reading, Rory Johnson's great substack, Commodity Context. And, it's just amazing to see the chart. So what we're seeing is essentially a decapitalization of prior investments with a focus on cash flow for the shale firms that are operating in the shale patch today. And once that goes dry, the other thing that we talked about in that piece was we borrowed some great work by Josh Young over at Bison Interests, and his long-standing hypothesis that OPEC Plus doesn't have the spare capacity it brags about having. And we see yet again in December that they underproduce versus target substantially. You mix in what's going on in Kazakhstan right now, that 1.5 million barrels is pretty important for European refineries. It's not like you can just replace that light crude with sour crude and expect that the European refineries are going to be able to operate. So when you mix it all together, if Omicron is not going to be as serious as people think, and the economy reopens at a faster rate, you could have a huge inflationary pulse just smashing into the face of limited supply at the wrong time. And that's why, despite Biden's job owning and releasing of the Strategic Petroleum Reserve, we're sitting here this morning with, WTI back above $80. Mm-hmm. And we think on the way to much, much higher. Not investment advice, of course.
Of course. And you also put an interesting part in that piece about what role the emerging economies add to this demand for oil as they transition out of, let's say, poverty into the, for lack of a better word, the modern way of life. So how much demand does that help create for oil?
Yeah, it's a really important question and one that very few people talk about, but there's a wonderful chart put out by Morgan Stanley that plots on the x-axis human development index, and then on the right axis, the vertical axis, the amount of energy per capita per year that a country uses. There's an inflection point sort of as emerging economies emerge, and they make that standard transition from burning biomass to burning coal to burning oil to burning natural gas, and then eventually nuclear. That's sort of the energy return on energy investment ladder. Mm-hmm. It's a huge inflection point. And most interestingly, the chart shows that there's 5.5 billion people on the planet below that inflection point. And all of those people want to reach that inflection point. And the biggest dot of them all, which is right at the knee of the exponential, is China. And so China is just at the beginning of the point where the gigajoules per capita per year that they consume to get the next increment of human development index growth is going to be exponential. And so they're going to run their economy in a way that optimizes their domestic human development index, and they're going to need a lot more energy. And what we do in the West is important. And we're not anti-green. We're not, pro-pollution. We do believe that if we're going to solve for carbon intensity, there are smarter ways to do it than the way we're doing it now. Mm-hmm. But we're going to see a huge spike in demand, or we're going to see riots. And by the way, you never know where they're going to manifest. And Kazakhstan came out of nowhere. I don't think anybody had Kazakhstan's civil war in the first week of January on their bingo card. But Kazakhstan is critically important. They're 1.5 million barrels a day of oil. Mm-hmm. They're 40% of the global uranium supply. Huge potassium producers, according to somebody on Twitter that tweeted at me yesterday. So it doesn't take much in these highly inelastic commodity markets for things to really explode. And we'll see. It's called Doomberg for a reason. Nobody comes to us for the cheery, rosy outlook. Mm-hmm. We are a bit sort of on the pessimistic side, but there's lots of reasons to be pessimistic looking at the news flow these days.
Mm-hmm. Absolutely. And as you say, when we look at how much, just as an example, how much uranium Kazakhstan actually produces, I believe I was reading this morning, it was like 43% of the world's uranium, which is cumulatively more than number 2, 3, and 4 all put together. So why to you guys is nuclear such an important aspect of baseload power? And again, how short-sighted do you think it is to be turning away and turning off some of these nuclear plants?
So there is no path to even moderate decarbonization of the economy that doesn't use nuclear and doesn't result in the starvation of hundreds of millions of people. It's just that simple. So either you're pro-human or you're not. And we view an environmentalist stance on nuclear power as a measure of their seriousness. If somebody claims to be an environmentalist and pretends to be pro-human, but is also anti-nuclear, then they are just unserious or worse. We do not have the technology suite available to us today to even moderately decarbonize our economy that doesn't involve nuclear and doesn't involve starving a lot of people. So from what basis are you measuring success? So we would begin with, we would like to elevate as many humans to a higher standard of living as possible while minimizing the irreversible impact on the planet. There's trade-offs to those decisions. We wrote a piece about New England's insane energy strategy called New England is an Energy Crisis Waiting to Happen. They've stunted and shut down nuclear. They have opposed all natural gas pipeline development. And the sun doesn't shine as intense in the winter as it does in the summer. And they don't yet have enough renewables to, there's a capacity factor for renewables too that make them very poor, as you probably know, for baseload power. So if they had kept their nuclear going and built out nuclear while building out renewables and replacing coal with natural gas, that would be a sensible policy that would achieve the trade-off of robust, secure, life-giving energy, enabling economic growth in the region while minimizing the irreparable damage to the planet. If our objective is to get to zero, there's not going to be any humans. And it must be said, there is a small percentage of the most sort of extreme environmentalists who believe that our impact on the planet should be zero, and that humans shouldn't exist, and that we are a cancer on the Earth's environment. If that's your policy, then you should say that and put that out for people to vote on, because, you are going to see what happened in Kazakhstan eventually happen here. It's impossible that the people of Canada will accept that they're just going to freeze in the winter without doing something about it. And so if the natural and irreversible consequences of your decision flow lead to that scenario, something has to give, and something will give. And we're already seeing it give in Kazakhstan this week.
Yeah, it seems to be when your energy cost, is it energy and food cost, reaches 40% of your monthly expenses or income, that becomes a real pain point where we see these types of riots start happening, right?
Absolutely. And one of the things, if you just do the thought experiment and play it forward, is we suspect that the entire European Union might collapse if they don't correct themselves pretty soon. And all the evidence indicates that the leaders have no desire to correct themselves. And so something will give, whether it's at 40%, and there's an expression in the prepper community called sort of 9 meals to crazy. Like if the grid collapses, most people are unprepared for it and they're going to get violent. And so when it comes down to, I'm staring at my family and I'm angry because I don't have the things I need to ensure their livelihood, people do revolt very quickly.
So, when we think about the differences of today's society, and we think about the last time we really saw riots like this happen where there were major energy shortages, I'd like to talk about another idea that you brought up in another one of your pieces. And that's how the aspect of social media could speed up basically the inflationary expectations when we start thinking about $300 a barrel oil. So talk to us a little bit about how you see that dynamic of social media playing into the expectations factor here.
Yeah, the very first piece we wrote was about inflation. So again, because we come from industry and we're not sort of trained macroeconomists, professors or commentators, we have a different source of input which shapes our thinking, which is all of our friends in the C-suites of the companies we know and deal with on a daily basis. We're screaming out loud about supply chain crisis coming. We have a shortage of labor. Prices are going up. Inflation spike is real, and so on and so on. Now, to your question, it had occurred to us, because we're very active on social media and we study it very carefully, both for our business and out of curiosity. This is the very first time in history where we are experiencing an inflationary pulse in the era of social media. And economists tell us that inflation expectations feed inflation, and that this can become a self-fulfilling prophecy. If the public begins to lose confidence in the currency can collapse rather quickly. And one of the things that scares us that we try to highlight is the social media algorithms can shape people's expectations. Mm-hmm. And in particular, some of these social media companies are not controlled by people who like us. So for example, on TikTok is a Chinese company. And there's a lot of controversy in the US as to whether TikTok should even be allowed in our country. Mm-hmm. We point out that, the first $20 Big Mac, if a Big Mac were to rise in price to $20 and an influencer on TikTok made a video about that goes viral, that begins to feed inflation expectations in a way that we suspect the Fed has no idea or doesn't even think about. And so the traditional ways to measure expectations might tell them everything is going to be fine. But if every day a video on TikTok or a tweet on Twitter or a subreddit goes viral and begins to shape people's expectations, the authors of those viral social media morsels may be doing it on purpose. And they may not like the US dollar, and they may not like that the US sometimes uses the SWIFT system as a means of economic warfare. And they may want to destabilize the US dollar. And at a minimum, even if they don't, we have exposed ourselves to the fact that somebody could. And so that's one of our primary things. We've written about it 4 or 5 times. We wrote a piece called "We're About to Run Out of Some Stuff" that subsequently proved to be pretty prescient. This is a dangerous experiment we're running. And even if we can circumvent the immediate negative consequences of a hyperinflationary burst, we argue that the path from elevated to hyper is a lot shorter than people think in the era of social media.
Yeah, it's really interesting to think about how that could really start to move demand forward. And I'd like to go back one step again here, where we're talking about what is really affecting staples that we're going to be needing every day. So let's talk about one example that you guys brought up about ammonia and about fertilizer and how many different, again, downstream effects this shortage is going to really start affecting without seemingly, being interconnected as one would normally think of it.
Yeah, this falls under our broad category of things that we take for granted that we don't understand. And when I say we, I mean the broader public. Mm-hmm. Things that we take for granted that we don't understand how they're made. And we can't, therefore, because we're, especially our political class, is broadly uneducated on the interconnectedness of our sensitive supply chains. They don't understand how decision A snaps down the alphabet whip and ends up with a really bad outcome at Z. Mm-hmm. And one of the very obvious ones, because it's only simply, one step down the supply chain, as we predicted and others had as well, that the natural gas crisis in Europe, which subsequently spread to Asia because they're both bidding for the same incremental cargo of LNG, that would radically affect the fertilizer market. And we wrote a really biting piece actually several months ago called Starvation Diet, where we basically, having seen the natural gas prices already beginning to elevate in Europe, we know intuitively what that means. What that means is the price of fertilizer is either going to skyrocket or non-exist because producers of fertilizer, natural gas is a really important input into fertilizer. The way we make fertilizer today is you effectively, in a controlled burn, create hydrogen from natural gas and react it with nitrogen out of the atmosphere in something called the Haber process. It's a big, ugly, commodity, capital-intense process that has some environmental impact that we've decided to mostly offshore. And China's a big producer of it. The natural gas crisis in China caused the Chinese to stop exporting the other half of many fertilizers, which is phosphate. And we know what that means. That means you're going to see fertilizer prices skyrocket, and they did. And you're going to see farmers plant less in the spring, which we will, or pay way more for fertilizer, which they are, which ultimately has to manifest itself in much higher food prices. Mm-hmm. And when you have much higher food prices, history teaches us that people starve. Mm-hmm. And so we just drew the direct line from a bundled energy policy in Europe, as we described earlier, to the consequence, which is a bunch of people are going to die. I'm not going to die, knock on wood. You're not going to die, knock on wood. We will find a way to afford the things we need. Mm-hmm. It'll be an inconvenience for us. It'll be life and death for the millions of people, billions of people for whom they don't easily have the ability to meet the sort of base of the Maslow's pyramid of needs in an economic way. And, we wrote a piece early on, and that means far fewer people have read it, but we wrote a piece that basically described how energy is life And the title of that piece was Why Are Cows Sacred? And cows are sacred because they're the first solar powered renewable battery. Cows allow us to eat cheese and milk from grass that we couldn't otherwise eat. Mm-hmm. Grass is nothing more than a temporary storage of the sun's incident power. And so a cow grazes, eats things that we can't eat, and then converts a portion of that energy into things we can. Milk, and then cheese is a way for us to store that energy. And then ultimately when they die, they give us their last gift of, meat. So cows are sacred for reasons because they enable humans to live and to eat. And energy is life. And for a huge part of the world, they don't have the luxury of flipping a switch and having the light go on, or turning on a tap and having clean water come out, or opening up a refrigerator and having food that is safely stored because the temperature is low. These things are all directly tied to energy. The fertilizer market has blown off. Prices are 4 or 5 times what they were last year. And it is just impossible that this doesn't materialize in a very negative way for lots of people.
Mm-hmm. And I think, another great example, and again, seemingly unrelated, is a piece that you wrote about entitled How to Brick an Entire Economy. And in it, you raise the example of how this ammonia shortage, which we think about in fertilizer, can also affect the entire shipping industry of everything in a country, or maybe we should say trucking industry. So how is Australia being affected by the lack of quote unquote fertilizer or ammonia?
Yeah, so one of the ways in which ammonia is moved around the world is by creating urea, which is just reacting ammonia with CO2. And again, it's sort of same story. These are old tapes. China has taken over much of the production of that critical good. Mm-hmm. And there's a trade war going on between Australia and China, but also China has an energy crisis. And China has really circumvented the export of urea. Well, what is urea? Urea is fertilizer, but urea is also DEF, diesel emission fluid. And so we described in this piece, and we have some experience from our time in industry on how this technology evolved. But, diesel-powered trucks are critical for the dispersion of goods throughout a society from producers to consumers. And if diesel trucks stopped running even for just a few days, economies would collapse. And the reason why economies would collapse is because we have created this just-in-time supply chain where, the grocery stores have only several days of demand on their shelves and they're continuously being replenished. That continuous replenishment is powered by diesel. Diesel emits a lot of toxic fumes. I've certainly driven behind many a diesel pickup truck that spews a big black cloud of nastiness when they accelerate. Mm-hmm. Sometimes it feels like they're doing it on purpose to, put the oil slick in the car behind them. But nonetheless, the EPA and other global environmental regulators correctly insisted that these trucks become much better at handling their pollution. And the technical solution that won out was DEF, diesel emission fluid, which is basically a 37% solution of urea in distilled water. Mm-hmm. So it's literally just fertilizer in your truck. And what happens is that urea gets injected into the exhaust, and then it goes through a catalytic converter, and it knocks down the NOx substantially, NOx. And that's fine. That's good. That's great. We applaud it. It's actually a substantial environmental leap forward to clean up the emissions from diesel trucks. The problem, of course, is if you don't have supply of urea, which Australia doesn't because it doesn't make much of it and relies on imports from China, who doesn't like them, at least temporarily. What happens is when these trucks run out of DEF, they brick. They literally are programmed to not drive. And the circumvention of that reality is very difficult, and it's not a light switch. And so Australia is facing a substantial shortage of urea. Now, will their economy eventually get bricked? No, I doubt it. Will they find a way to get just enough in to keep things going? Sure. But we got into a situation where the global trucking industry of Australia was weeks away from running out of DEF. And it would take about a few days for that consequence to really manifest itself in a terrible outcome for many people. Mm-hmm. And so these are just very simple things, but you can very quickly draw the line from Europe didn't fill its natural gas storage, which led to a spike in the demand for limited supplies of LNG. China's competing for those same supplies of LNG, so the energy crisis rolled into China. We have exported our manufacturing capacity to China. If China has an energy crisis, it's going to be felt in crazy, somewhat unpredictable ways in the West. And the DEF story, as we told it, is just one of those accessible ways for people who read it to understand, I see. Mm-hmm. Our whole society is deeply interconnected. And maybe we should give some thought to before we close down Line 5 or shut down Keystone Pipeline or approve an LNG export terminal or approve, drilling and exploration permits for our domestic suppliers, because the strategic net outcome of our set of tactics is that the people that control the energy cards are people that don't like us. And because energy is life, we have delegated our control over our lives to people who don't like us. And that's an ongoing theme in all of our pieces. And the DF, how to break an entire economy piece was just another example of tying those dots together for people in a way that is easily consumed.
Mm-hmm. So as you're saying, we've ceded these markets to people that don't like us. What other industries does China really have a stranglehold on that could be absolutely crippled if they continue to have these protectionist policies in place when they seem to be running out of certain goods and commodities?
Yeah, and I should state up front, I don't blame China one bit for any of this. I blame us. This is our fault. We control our policy, not them. They're just taking advantage of our stupidity. There's no other word to use. It's stupid what we've done. There's several examples. So one of them that we talked about is in solar. So we were in the polysilicon market in our professional lives when China stole that market from the world. And China now makes the lion's share of all the polysilicon that goes into solar panels that you see either on your residential products or in commercial solar fields for grid power. There's literally only 3 polysilicon plants left in the US. There's not enough polysilicon to go around if we continue on this path of mandating its use. And what we saw is one of the first things, if you take sand and make an ingot of polysilicon solar grade, that's an incredibly energy intense process. We know it. We used to be in the industry. Mm-hmm. China stole our intellectual property, flooded the world with cheap polysilicon using effectively slave labor, and also zero environmental protections, domestically, which made it impossible for Western producers of polysilicon to compete. So they got out of the business. And now the first thing China did when they began to suffer the energy crisis that was born in Europe is they shut down as many energy intense industries as they could, as certainly the export of those materials. And so the price of polysilicon skyrocketed. Again, all these charts look the same, Tom. Stable, boom, because there was no more polysilicon being made. Another really important one is magnesium. We wrote a piece called Magnesium PI, and exact same story. The US used to dominate the production of magnesium. China took over the market. China now produces 85% of magnesium worldwide. And turns out that you can't make, aluminum composites for vehicles without magnesium. And concurrent with China taking over magnesium, we've had a huge push in the US and in Europe and in Canada and the Western world, as we would call it, to lightweight our vehicles because the fuel efficiency standards are easier to meet if your car gets lighter. And one of the ways that the auto industry has done this is through the systematic replacement of steel, which is heavy, with aluminum composites, which are light. And they've been able to shed hundreds of pounds of weight from each car using these composites with minimal impact on the safety of those vehicles, which is a miracle of modern technology and great, and we applaud it. But if you're going to do that and mandate effectively its use, you need to have access to supply. And there was a point in Europe where the entire, automotive industry was warning, local leaders that a urgent shortage of magnesium from China was threatening to shut down the entire economy. And so supply chain after supply chain after supply chain, you see the exact same phenomenon. It's all controlled by China. It's energy intense. China's energy policy is not, their strategy is not perfect. They're short fossil fuels. They have to import a lot. You're seeing a huge ramp up now in China's use of coal to try to stabilize the energy situation, which does have substantial negative economic consequences. And you're seeing, thankfully, also in China, a huge build out of nuclear power because they see the writing on the wall. So, these are all, it's just amazing for us to watch given our experience, but they happen and it's real and it's going to happen again and again and again. And so, magnesium and the criticality of it is something that we highlighted to our readers.
Mm-hmm. Yeah, it's really interesting to think about, if they want to stop sending or exporting these raw products to the rest of the world, what those downstream effects can be. But I'd like to turn to talking a little bit about gold now. How are Russia and China, as we've been talking about, and thinking about the economic consequences or beneficiaries at times here, how are they the main beneficiaries of the paper gold suppression?
So, you sort of watch what people do as opposed to what they say. And I'm not sure that the price of gold is truly suppressed by paper. I know that's something that a lot of people believe, and it's not something we've argued for or against, but let's assume it is. What happens when you suppress the price of gold? Well, what happens when you suppress the price of anything is that you increase demand for it. And it's just unquestionable that China and Russia and India and other countries are hoarding gold at these, what you would call artificially low price. And so Russia is making many moves. China is making many moves along these ways, gaining access to critical materials, storing gold. China and Russia in particular have a huge amount of gold in their official reserves, let alone their unofficial reserves. There are many market commentators that believe the reported amounts of gold vastly understate the true internal supplies. And in particular, China, it's not like you can export gold of any size in China. So all the gold that China produces domestically is basically just going towards what I suspect they believe will be the great fiat currency reset. And if gold is going to be a critical part of how the new currencies are valued in a post sort of debt jubilee world, then we would argue that China and Russia are far better prepared for that negotiation than we are today. And so, again, the paper price of gold, we like to buy physical. We don't believe that GLD is necessarily like the best way to participate in gold, but we don't view gold as an investment. We view gold as money. And we just responded to a written interview yesterday. Well, we like to earn our income in fiat. We save our money by buying real assets, and we invest privately where we can affect the outcome. And so we would count gold as one of those real assets, land, gold, useful material goods that are going to be useful in all economic scenarios, especially so in an inflationary one. But gold is for sure being thought of and treated differently by different governments in the world. And China and Russia have sort of a more traditional Austrian view of gold based on their behavior.
Mm-hmm. So in that piece, I think you wrote basically that a debt jubilee is inevitable. So what power dynamics need to be considered to understand what that post-jubilee world looks like?
Yeah, and to be clear, inevitable could be 50 years, could be 100 years. Nobody would argue, nobody sane, I think, would argue that we are capable of paying back the debt we've accumulated through excess economic growth. We are basically insolvent. And by we, I mean the Western world, European Union, Japan, Canada, US. We have accumulated official and unofficial debt and obligations to the point where we're eventually going to have to print our way out of them. It's just inevitable. Just take, for example, the medical promises that we've made to people. Those aren't dollar promises. Those are service promises. And those are tied to inflation. And so the obligations grow with inflation and really can't be printed away. And so if you just look at the US deficit, if you just look at the growth of US money supply, it is, if debt can't be paid back, it has to be restructured eventually. And there's only so many relief valves available. The history of all global fiat currencies is pretty boring in a sense. They all go down the same path. They gain control over the printing press and they try to print their way out of problems, and the currency fails. What's unique about this time is that the global central banks are, some would say collaborating, others would say conspiring to do it all together all at once. So it doesn't appear as though that something amiss is, if you measure the value of the US dollar against the euro, it doesn't look like the US dollar is in any jeopardy. And so one of the reasons why people point to what they believe is the price suppression, the paper price suppression of gold, is because the Western central banks don't want to make it look like they're losing control. And if gold was at 5,000 or 6,000 or 10,000, that would give the appearance of it, given gold's prominent place in society. And so to the extent that is true, if it is true, then China and Russia are certainly better prepared for it. China has a lot of debt, but Russia in particular is, if you just actually analyze them objectively, without getting into the, Putin is a bad man, ad hominem attacks, they have pretty decent setup macroeconomics, reasonable debt. They just raised interest rates to try to get inflation under control. They have pretty powerful access to commodities. They're not perfect. They got lots of problems too. But, this debt jubilee, back to your original question, I don't know how we get from here to there. If the Fed loses control, it could get ugly pretty quickly. One of the pieces we wrote about was this scandal of the insider trading at the Fed. Mm-hmm. And it's really outrageous. And that's very dangerous because the confidence in the Fed is really the sort of the last piece of the Jenga pile that's keeping the whole tower upright. Mm-hmm. And if we pull that out, the whole thing could collapse. And so whether it's now, whether it's 10 years, whether it's 50 years, this debt isn't going to be paid back. And debt that isn't paid back needs to be restructured.
Mm-hmm. So as we're talking about the Fed, what role does it play in also, underplaying the value of gold? In your piece called Golden Deception, you found the same thing I did when I was trying to look at how much gold the Fed actually holds. And that's that they still value the gold that they have at the 1971 value of $22 an ounce. So why is this?
Yeah, it's a fascinating thing. And I think it goes back to the same phenomenon of confidence. And by the way, we should both say that, at least I found that from Rickard's very interesting book, we didn't, mm-hmm. And it just occurred to me in reading his book that, hey, well, so people look at the Fed's balance sheet exploding so high. And if you just look at the reporting numbers and the way in which they carry gold, the Fed leverage ratio, because the Fed is basically a bank, which is it's the amount of assets that it has to support the liabilities, just without sort of valuing the gold properly, that Fed ratio looks like it's over 200, which is deeply insolvent for a bank. Just to benchmark you, it should, somewhere around 10 to 20 is typical, and 30 was sort of, global financial crisis level with the collapse of Lehman Brothers. But if you actually correct for the price of gold, then the leverage ratio becomes a lot more reasonable, closer to 15 or 20. Mm-hmm. And I think the reason why they carry gold at cost is because if the price of gold mattered a lot to the Fed's balance sheet, then the price of gold would get a lot more attention. And so the fact that they keep it at $40 an ounce or whatever the exact number is just sort of another way to sort of distract people from it, because it long ago stopped mattering as a component of the Fed's balance sheet, and people were okay with it. And so they've just sort of steadily been led down the sort of propaganda path of gold doesn't matter. Gold isn't a hedge against inflation. Gold is a pet rock. Gold isn't money. Believe in the US dollar, et cetera, et cetera, et cetera. And per, Rickard's book, his belief was that the Fed has never really been insolvent, because if you actually correct for the mark-to-market value, they have a ton more equity on their balance sheet than they do. I just think they want to have their cake and eat it too. They want to have the gold so that the global sort of confidence in the US dollar stays elevated so that the US dollar can keep its reserve status, but it doesn't want the US population to tie the value of their gold to having any meaningful relation to the value of the dollar.
And that's pretty convenient, considering that, most people would not remember what the value of gold was in the 70s compared to what it is now, right?
It was actually quite difficult for us to reconstruct the entire history mm-hmm. of the Fed's balance sheet. We had to pull it from multiple sources, and we have a Bloomberg terminal. It only goes back so far. And we found this great website that did a lot of the work for us. And then once we combined what we had from the Bloomberg terminal with what we found on this website, we were able to recreate the Fed ratio charts and the equity charts and all of that stuff that the Fed produces in a way that corrects for the actual price of gold. As I'm talking to you, I just wanted to sort of pull up and look at some of those charts, but it's a pretty interesting thing. And the Fed doesn't report it that way, and they must be a reason, right? And I think the reason that we just articulated is it.
So what would the price be if we backed dollars by 20% in gold as we did in 1976?
It's an interesting question. If we had to keep the Fed percent of the assets on the balance sheet at 20% gold, right now it is at, I'm just looking at the chart, let's call it 7%, 6%, then it should be about $6,000 an ounce, mm-hmm. was the number we came up with in the piece. So that is some evidence of, now of course 20% is an arbitrary number. Back in the early 80s when inflation was running hot, and Volcker came into the Fed, the gold was 50% of the Fed's balance sheet. Today, it's under 10, somewhere between 6 or 7. And so, if you pick 20% as a reasonable number, then of course, monetary theorists say that gold is nothing. And so there's no reasonable percent and it doesn't matter. But the rest of the world probably doesn't come to that view. And at 20%, it prices out about $6,000 an ounce, at least back when we first published the piece, which was, sometime in June of 2021.
Yeah, so a little bit of debt ago, right?
Yeah. Again, we're on this, but like I'm old enough to remember when $1 billion was a lot of money. Mm-hmm. And I remember the great bazooka of the global financial crisis was several $100 billion, and people were shocked at this. And several $100 billion, I mean, I don't know if that Congress would bend over to pick it up if it was lying on the side of the road. Mm-hmm. That's not even a number that registers anymore. It's trillions, and soon it'll be tens of trillions. And this is sort of happening at a pretty accelerated pace. We'll see if the Fed can taper. I don't think they can. I think, well, they certainly can't taper without triggering a substantial market crisis. And history teaches us that they'll try. The markets will burp, and then they will very quickly revert back to the old ways. And so that's why we think this debt jubilee is irreversible. And the amount of gold that we have matters. Certainly the amount of gold that we have as individuals matters a lot to us. We keep a pretty deep inventory of real assets that we believe sets a floor for our ability to participate in a post-collapse economy.
That's an excellent way of putting it. So when we think about the way in which companies are valued at this point in time, I want to get your thoughts towards, something that the way that you put this was that metals investors look stupid right now. So Why do you say it that way? And do you think that these investors are eventually going to be proven that gold still has real value?
So to be totally clear, we wrote a few pieces that we call the Super Stonks series, where we look at just how crazy some of these companies are being valued. And we, in a joking manner, labeled valued investors as money haters. And we labeled traditional valuation analysis as the stupid way of looking at money. Mm-hmm. And so by the stupid way of looking at money haters in the metal sector, if you're going to post your returns against, let's say, Bitcoin or against some of these meme stocks or against the standard, the S&P and QQQ looks crazy on a chart. What you're buying when you buy a company is either a claim on future dividends and a terminal value, or the right to sell it to another sucker. Those are the only two ways in which you're going to get money back from your investment. And at the peak of bubbles, investors like us, I'm sort of making an assumption that the overlap in the Venn diagram of things that we would invest in is pretty high. Mm-hmm. We don't look very smart. When the bubble collapses, then you look smarter. We're certainly not calling that the bubble is going to collapse, although if we look at some of the bellwether names, they do seem to be expressing substantial red flags, that there's something going on here. In particular, if you look at sort of ARK Invest and sort of the basket of stocks that they invest in, they're down 40, 50, 60% below market. This does have a 1999, 2000 feel to it. It has a very similar feel to the dot-com bubble. Timing up the burst of a bubble is impossible. In the long run, if you buy inflation hedge future cash flows from well-run companies with solid balance sheets, you should do okay, unless we hit hyperinflation, and in which case all bets are off. Mm-hmm.
So how do you view the different roles of gold and silver from, say, a usability and demand standpoint?
So we view gold as money, and we view silver as a hybrid of a diminishing aspect of money with an increasing industrial use. And so silver certainly used to be money. It's much less so now. Still is money, but is also substantial industrial use for it, not the least of which is in the production of solar panels. And so gold, for example, we wouldn't do a canvassing of the gold mine production globally as an input into what the price of gold should be, because there is no price of gold. Gold is money. We would view the price of US dollars as expressed in ounces of gold as a more proper way to look at it. Mm-hmm. Silver is a different story. Silver has annual production that is consumed, and the amount of silver produced is an input into the price of silver, and the amount of silver that is used in various industries is also an input into the price of silver. And so I would separate the two. Silver is not quite nickel and copper, but if you were to draw a chart with gold on one end and let's say, copper on the other, pick your favorite sort of purely industrial metal, silver is somewhere in between. Mm-hmm.
So you mentioned Bitcoin a little bit earlier, and I want to get your take on how the advent of cryptocurrencies, plays a role in the market right now. I've heard you say that it's possible that they are a symptom of a population recognizing that their currency is becoming worthless. So why do you see that?
One of the things we try to do as a firm is study significant historical events and try to gain an understanding of what the people were thinking as it was occurring. And one of the events that we studied a lot is the hyperinflationary outburst in Weimar after World War I in the German Republic of Weimar. And one of the characteristics of the early stages of that hyperinflationary bout was, for the time, absolutely fanatical and crazy speculation in all manner of worthless things, as people rushed to trade what they perceived to be collapsing fiat for literally anything. Now, I'm not saying that that's what cryptocurrency speculation is. I'm saying it reminds us of that. So cryptocurrency speculation has multiple ways for us to go about it. One of the things for sure that we see is, to the extent that people have been convinced that Bitcoin is an inflation hedge by people like Michael Saylor, it is diverting dollars that might have otherwise gone into gold as inflation has begun to spike. So there's just no arguing the fact that the flow of capital, fiat capital, to the gold as a storage of value is not what the people who are proponents of gold as a storage of value would have liked or would have predicted. Mm-hmm. But another thing about the stablecoin industry is it's completely unregulated. And we have always been very careful to separate the technology components of cryptocurrencies to the price. And so we don't know, we don't understand, it's not our expertise, which of the subset of cryptocurrency technologies will play a prominent role in the economy in the decades ahead. Mm-hmm. But we do know that the price of Bitcoin is driven by what we believe to be a fraudulent entity, Tether, which is basically funny money. And the price of Bitcoin involves all manner of wash trading and all kinds of things that in regulated markets would get you in prison. And so we don't view the price of Bitcoin as having much meaning. So one of the questions we ask people who are Bitcoin maxis when we do engage them, which is rarer and rarer now because it's just not worth it, the juice isn't worth the squeeze, mm-hmm. is, the total value of the crypto complex. Let's just draw a box around the crypto universe, the paper value that people ascribe to it, let's call it 2 trillion. Our question to them is, what is the total value of hard fiat, which is sort of an oxymoron, but compared to crypto, it's harder. What is the total value of fiat that's floating around in that universe? 20 billion, 30 billion, 50 billion, maybe. So if everybody tried to get out at the same time, what we tell people is that they should price Bitcoin in tethers, not in US dollars. And if they price Bitcoin in tethers, then you have a different way of looking at things. Well, what's Tether worth? Well, that's an interesting question. The Tether is resisting in courts to reveal. Mm-hmm. 80% of the transactions in Bitcoin occur in Tether. Price is set at the margin. If an entity can produce billions of dollars of Tether, which everyone thinks is backed 1-to-1 by US dollars without having that backing, then what does price really mean? What does the price of Bitcoin really mean in that context? Mm-hmm. And the on-ramps are easy. The off-ramps are hard. And so, we're a no coiner. We've never held a Bitcoin. We don't have a wallet. We would be laughed at as old people shaking our fist on the lawn by people in the Bitcoin community and the cryptocurrency community. And so be it. We're just one voice in a wave of people talking about it anyway. And it's not a strong position of ours to write about a lot, but count us amongst the skeptical of the price of Bitcoin. We're not making a comment about the technology. And, it does impact gold, like we said. So.
Yeah, it's an interesting thought to price Bitcoin in Tether. And it would probably look a lot like the US dollar chart over time, because as more and more Tether are issued, that would just, devalue the price of Bitcoin, right?
Well, and again, these are highly unregulated markets, mm-hmm. and we have regulators for a reason. I don't love our regulators. I think they make lots of mistakes, but there's an avalanche of wash trading where, especially like in the NFT space, by the way, we think there are very, very substantial use cases for non-fungible tokens. And we think that once this era of speculation collapses, as they all must, that there will, from the ashes of despair, arise substantial and important economic impacts from the development of NFT as a technology. It doesn't mean that JPEGs of monkeys are worth millions of dollars. What you'll typically see, not typically, what you can see in an unregulated market is, Doomberg and Tom trading the same entity back and forth to each other elevating the price artificially and then dumping it on somebody for a fraction of what the last trading price was between you and I, but for substantially more than what it's actually worth, which is zero. Mm-hmm. And so there's wash trading, there's fake trading, there's fake volume. These are unregulated exchanges. It's very easy to put your US dollars in or your Canadian dollars in. Sometimes it can be very hard, especially if you've grown your account, to take your money out. People get mad at us when we say that, and we say that's just FUD and whatever. It's fine. Knock yourselves out. Enjoy the party. Mm-hmm. Good luck to you. We hope that you make lots of money. We just caution our clients and ourselves to stay out of this speculative mania, because it's just not how we can sustainably make money. If, we can't time markets. We can earn income, we can save in real assets, and we can invest privately where we can affect the outcome. And that's working great for us. Mm-hmm. And so, the Bitcoin maxis would say, have fun staying poor. We would reply saying, we're having fun staying perfectly well off. Thank you.
And another great example of that right now is, as we discussed earlier, is in Kazakhstan. They're one of the bigger Bitcoin mining countries. And with the internet effectively being shut off right now, there is no mining or transactions being able to be made in that country, right?
Yeah, and then also they were attracted to that country because it was perceived as being an infinite source of low-cost energy. Of course, there's no such thing. Mm-hmm. And again, I'm not trying to come off as sort of anti-Bitcoin or anti-cryptocurrency. We're just sort of pro-reality. Mm-hmm. And so, that energy. Now, there is, I was on a podcast with my friend Max. The name escapes me. His podcast name escapes me right now. But he makes the point that there are some use cases where you could use, for example, Lynn Olin has written about the use of Bitcoin mining to take flare gas that is otherwise burned or flared into the atmosphere and convert it, in mobile trucks to useful power that could run Bitcoin miners. And, there are an infinite demand of very cheap energy that otherwise grid operators would have to waste. And so there's maybe a use case or two, but broadly speaking, energy is life, and mining cryptocurrencies is probably not the ideal use for the incremental supply of energy when we're running short of it.
Mm-hmm. Well, Doomberg, I want to thank you for a very wide-ranging conversation here. Talk to us a little bit about your guys' decision to publish all of your content on Substack.
Yeah. So first of all, thanks for having us on. It's been a very engaging discussion, and appreciate the opportunity to talk about some of our work and to showcase our work to your audience. We publish everything on Substack. Our address is doomberg.substack.com. We're on Twitter at DoombergT, just add a T to the end of Doomberg. Those are the two places where we put most of our content out. And we decided to go with Substack because we think there's a emerging gig economy for brains where content creators are lapping traditional media. And if you do it well enough and you research your pieces and write them well enough and edit them well enough and visualize the data well enough, that you can stand out and you could grow and you can turn it into a business. Our intent is to eventually convert Doomberg into a sustainable business where Doomberg is the only thing we do in our lives. And what a great privilege that would be. Mm-hmm. And so if people are listening, enjoyed this conversation and want to head over and help us do that, we would certainly appreciate it.
And just as a note, all of your articles are available for free. And, there's just such a wide range of material and interesting, well-written, sometimes sarcastic, but just excellent articles that really make you think and put it in terms that anybody can understand. And I really appreciate your time today and getting to speak with you and talk about some of the excellent work that you guys do over there.
Appreciate it. And happy to come back anytime you'll have us, Tom.
Excellent. Thanks so much for your time today. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.